up. Any of these macroeconomic things could mean one of two things, good or bad news. It depends how the market looks at it, half empty or half full. You see, falling interest rates could be a bad thing, depending on the economic context. It doesn't apply now, but in the past, falling interest rates is a bad thing because it means the economy needs resuscitating. So we need to cut people's cost of mortgages, for instance. At the moment, falling interest rates is seen as a good thing because the way the market is interpreting it is people will have more money, companies will have more money, consumers will have more money, they'll spend more. Let's boost stocks. So in and of itself, it doesn't mean anything. It's the meaning you attach to it, and you've got to then interpret, well, what's the meaning as the market attached to it? So very much that. AI earnings were great for AI companies, though Michael Burry's upset that those profits are inflated by, as I said, spreading costs out over too long a period. You know, he's not accusing them of fraud. He's just saying, well, you should say that you incurred all the costs this year, not that you've spread out this year's costs over 5 years so your profits look better. The companies are cash flow positive anyway, so I don't know what he's whinging about. China, Taiwan, one of my clients today said that's his biggest worry. Yeah, but nothing's brewing at the moment. There's so many Western spies in China in any event that if we get wind of anything, the West will step in to calm the Chinese down on that. Trump tariffs are not causing any problems. If anything, maybe that man deserves the Nobel Prize in economics, because what he said, that by having these big, beautiful tax rising tariffs, the budget deficit will decrease, the stock market will hit all-time highs. He's been right, contrary to what conventional economics would tell you, which is also a lesson. He's been right so far. It's also a lesson in bias and cognitive bias. People hate the man, so they hate the policy. As an investor, I couldn't care less about the man. I care about whether we can make money off the man. Okay, we've got Gordon in beautiful North Yorkshire County, Durham, also gorgeous. Make no mistake, these are wonderful places of the world. Everyone's in. The rest of you, if you're late coming in, let me know which part of the world you're from so I can give you a shout out as well if it's your first time. Remember this is not individual financial advice. It is not financial advice. It is for information and education, because I'm not speaking to you individually, speaking to people collectively. I do not know you, and therefore, from a legal perspective, you ought to know, but also from a moral perspective, you ought to know. This is not individual stock picking advice. How could it be? I don't know whether you're a 99-year-old grandma or whether you are a billionaire watching this on your private jet. Okay. If you need to get in touch with me, you can write to me. You can call our live phone number over there, or you can email paresh@tradermind.com. Any of those things. Okay. So Morgan Stanley think, and you might want to take a picture of this. You might want to pause it. You might want to zoom in later. They think 2026 is going to be a very strong year for the US markets. They think the US markets will go up 16%. In fact, the global markets generally, and there's a multitude of reasons they believe this. This image isn't theirs. It's what they're saying put into graphics by my team. They think there'll be global growth. They think inflation slows down. They think that growth comes from the resilient US consumer and artificial intelligence spending continuing, because if companies are producing profits, they've got cash, they're going to spend that money on AI is the game in town. So they think 14 to 16% growth in the US stock market, better than they believe Europe or Japan. And I have no disagreement with them on any of these things. Okay, just so you know. Choppy path government bonds, who cares? They think there's going to be a lot of economic activity. So my JP Morgan and Goldman Sachs shares should do well as well, because those guys continue making money on those. They continue favoring gold, copper, aluminium over energy. Fair enough. That's up to them. I'm less bothered about that. I don't need to have a finger in every single bloody pie. So what are their thoughts for Morgan Stanley? Overweight US stocks? Well, I always am, as you know. Fixed income? Well, for that, read cash, and I'll talk to how much. I'll tell you in a second how to work out cash. I've got a Goldman Sachs wealth management little image I want to show you, which I think is actually the best one for working out how much cash you should have. Some say it's a bit conservative. It's this one. Okay, that's the one. and you work out years to retirement. If you've got 0 years to retirement, you have about 50 to 60% in stocks and the rest in fixed income. By fixed income, just cash in a bank earning 4% or whatever it might be earning. Okay, so I like to show clients that because I think that simplifies that aspect very easily. And then whatever you've got in stocks, as a general rule, without it making it bespoke, 20 companies, 5% in each of them, equal sums. That's keeping it very simple without thinking about your risk appetite. We'll get to that later on. All right. So that's them. That might raise a lot of questions, such as, well, actually, I totally disagree. I don't care about the macroeconomics. I don't care about individual sectors. I care about individual companies. And when it comes to individual companies, all I care about in terms of that kind of a background is that these companies should have done fairly well over a prolonged period of time, and that they'll continue to do so. In order to determine that, as many of you will know, I use a database, and I'm very strict, which is why none of these companies meet my criteria. All these columns have to be green. I need my companies to be relatively undervalued, i.e. lots of profits for their stock price. So even NVIDIA counts because its profits are massive for its stock price. Lots of growth year on year. So an NVIDIA type would mean lots of cash return on capital invested. That comes from Goldman Sachs Wealth Management. So again, an NVIDIA, just to give you an idea, would match. But there's many other companies from very other sectors which might not. It's not that I'm going for a sector. I'm going for the company, bottom up. Profit and loss, balance sheet, cash flow. And the only way to do that is, first of all, the Nobel Prize winner Eugene Fama pointed this out, you need a large number of stocks to start with so that statistically you can filter it down to create your own index tracker, your own exchange traded fund, your own portfolio of, say, 20 companies. And why 20 I'll come to later on. I also cheat by using the Sortino ratio, which is this, which I got from the hedge fund industry. I completely stole it from them. All my best ideas are stolen from greater minds than mine, usually Nobel Prize winners like Richard Thaler, Daniel Kahneman, Eugene Fama. And it's why this book, which you can see me pointing out to you, I wrote one of my 18 odd books, an international bestsellers, where I list all of this way of doing it. It's why I won competition in the Financial Times. The Sortino just measures the average return, you can all understand average, versus the risk of missing that return. In other words, how quickly do companies bounce back? And do they fall very infrequently, very shallowly, and do they snap back quickly? Those three things are very important for mitigating risk. Quick snapbacks, infrequent falls, shallow falls. Okay. And that's what the Sortino mathematically measures. You can't do that by reading bloody journalist articles, right? Because that's what you're trying to do. And you get some journalist who gets paid. Well, when I was writing for the Financial Times 25 years ago, I'd get paid £1 per word. So you do not want to be, you want to be using data, because it also removes emotion. None of these meet our criteria. So let me go back into why, in a way, this is irrelevant for me. What Morgan Stanley have said, it's irrelevant because it's a great background. So I expect a good year, but let's say it was a bad year. My company should be resilient enough that should they fall, I'd want to buy more of them, and they should be resilient enough that they don't fall too much. So I win either way. And if there's a tailwind like Morgan Stanley is showing, I should win as well. Now, I'd rather be that guy who owns a portfolio who wants to buy more of when it falls than the guy who's trying to gamble on which sector I'll push, where is it going to go up or down. You can be that guy. You can also be the guy who goes to Ladbrokes or the guy who goes to Vegas. I'm not that guy for my pension. Got it? Let me address, I'm going to come back to the macroeconomics and the stock market and individual stocks in a second and which ones I own, what I like. But let me first of all tell you why pensions underperform. Okay, and 9 in 10 UK funds do. It's also the same in the US. And usually the reason they underperform is, as you will know, because I've said it many times, it's several things: poor fees, poor fund managers, invariably dimwits, who basically pick from a very narrow geographic group. So statistically are not picking the best companies at all. They're basically trying to pick the world's greatest football team from people from Watford, because they're picking from a small geography. That geography might be German companies, European companies, UK ones. They're not picking from all of them, or they might just pick from a sector. Oh, only tech, only AI. Well, what happens when that sector falls? And the other thing that they're handcuffed on is they can't go into cash in years like 2022, which I'm going to show you in just a second. Okay. which I'll show you just in a second, where when the whole market falls, guess what? They also fall with it because they cannot go into cash because they're not allowed. So we'll deal with some of these suggestions. First of all, make sure you get the information, and if you don't want to do it yourself, and learn how to do it yourself, because it's easier than learning to drive, by the way, then at the very least, for the love of God, please do an index tracker then. Okay. But everything that retail clients do and the mistakes they made have been highlighted by Nobel Prize winners, and I've repeated them in my Financial Times columns and in this book. And I'll show you where you can get a copy of that book in just a second. So those fund managers, when they think they're smart and they advertise, oh, well, we're in Meta. Yes, but in years like 2022, when it dropped 66%, they dragged down with it, which is why Scottish Mortgage Investment Trust has fallen. You don't have to do that. You could hold cash in those infrequent years when the markets fall. You can hold cash. Okay. How do you know to get out? I'll come to that in a second when we do the stock market update. We're not trading. That happens once in 5 or 6 or 7 years. They can't do that. That one period of holding cash, okay, and avoiding those deep falls meant that whereas they get you nothing over 2 years, there you go, 0% over 2 years, you get to miss, even if you miss part of that, a 50% drop, just half of that you missed and you got a 50% drop. And if you only got in very late anyway, you still doubled your money on the way up. So you get to double your money, even if you do half as well as them, i.e. exit halfway late and get back in halfway late. And they get 0. And that's Meta, probably the world's most watched company behind NVIDIA. Okay. And they drag you down like the Titanic. They won't let you go. So well, what do we do about it? Oh, push. Well, I've written it here, what you do about it. Okay. In summary, and we'll touch upon it in this webinar as well. Put another way, you've got a $10 billion problem. Morningstar data, AJ Bell said this, 9 out of 10 UK pension funds have underperformed the simple FTSE All-Share tracker over the last 10 years. And the FTSE All-Share doesn't even perform that well. Okay. It's UK companies. It's not as if they've gone and invented the Apple iPhone or cloud computing or any of those things, or AI processors. So they had a really small bar to outperform, and they couldn't even bloody outperform that, which is why your pension stinks and you're going to be working twice as long as you planned. And here are some of the worst culprits. So we put these down, and that's over 10 years. Now, just to give you an example, even if you had a simple S&P 500 tracker, then over the last 15 years, that doubled every 5 years. So $250,000 turned into $500,000, turned into $1 million over 10 years. Okay, doubled twice over 10 years, because that's what 15% per annum is. Right? These are the ones that Scottish Widows, Aberdeen, Standard Life, warning sign if you've got these, because that's their performance. I didn't do anything about it. It's really, really, really poor. And I can tell you, Rachel Reeves' pension has done nothing to help it. The reason it says Great Danes of underperformance is because these are the dogs. These are the absolute dogs of funds, because their performance is piss poor. Why? Well, because on a down market, they have to keep holding that nonsense and you're dragged lower, and they spray and pray, put little bits of money in a lot of companies. And so any ones which are good, which they use for marketing, we have got NVIDIA. Yeah, you got 0.00001%. Oh, but we didn't want the volatility. Why didn't you want the volatility? Oh, because it scares the clients away and then we won't be able to charge them fees. Okay, but you're giving them low returns. Yeah, but they'll only find out so late that they're with us for an even longer period of time, so we get to charge them fees for longer. I didn't say any of that. Eugene Famer, Nobel Prize winner. I did say, I wrote it in the Financial Times, actually, in one of my columns and in every single one of my books, if only people would listen. And there's been no change to all of this. Absolutely poor. So what's going to happen going forward? This is what's going forward. Arun, I'll do yours in just a second as well. Chris, I'll answer your question. So there's quite a few questions. I will answer them all. So this is what Goldman Sachs' view is. It's not their slide. It's my slide of their information. Okay. And we agree with it. So we don't have a problem with it. The dangers are a mild recession. I doubt it. There could be some surprise on productivity. It's not as good as we thought. I doubt it. More likely is the upside. But even were it to fall like in 2022, which was relatively unexpected, we will do one of two things. We'll either hold cash as we had to do in 2022. We didn't know we'd hold it for the whole year. January, we just said, let's just wait till February, and then February, wait till March, wait till April, and so on. That's our worst case, and that's fine. If we have to hold cash, we have to hold cash. I can't invent companies going up if there's none that are going up. We're certainly not going to gamble and speculate with the cash we're holding and just throw it around. It's our pension. It's my son's inheritance. So when I show you these companies, and then I whittle those 10,000 down to the best 200, and then pick 20 out of those, okay, for my son's inheritance or my wife's pension, then yeah, you better believe that I need to have the best information. I need to tick the value box, the growth box, the income box. Whereas what does your average fund manager do? They'll say, well, I don't know who you are, Alpesh. Your fund manager doesn't know who the hell you are. They've never met you. They just want to sell you a fund. So, and then they buy and sell stocks within that, and they don't know who you are. No, the sales guy does. The IFA does. He's the sales guy. Okay. You might go, what does that matter, Alpesh? They don't need to know me. Well, yeah. Okay. Well, why do you think the private banks like Goldman Sachs and JP Morgan get to know their clients? Because it makes a bloody big difference. If you know what they're doing. And I'm going to look at some of the bespoke stuff and how we construct that portfolio going on from that. So what's the most probable path? Resilience. The US will continue outperforming. Global data is strong. Inflation data is coming down. Regional economies are performing all right. Tariffs are not impacting things. Indian growth was 8.7%, some of the strongest that they've had in the last 40 years. And there's tariffs, sanctions basically put on by the US. Didn't matter. The growth is incredible. And if they get a trade deal with the US, it'll be even more. So global growth looks good. Consumer strength is still there. AI adoption is still there. Now, they won't always be this positive. By the way, if it isn't, I don't care either, because I've got good companies. I'll just have to wait a year, like 2022. It's like owning your house. If the price doesn't go up this year, you're not going to cry and go, oh, the price is going, why am I getting rich quicker? It's just the way it is. And that's the same with the portfolio. I do expect it to go up, but if it doesn't, tough. Think of it like your house, and it'll make you more rational. People are far more rational with holding their homes than they are their portfolios. Okay. I'm going to put all of this in a different way and summarize for you. Again, take a photo of this if you so wish, and let me explain it all to you. I hope you like these images. These are new, and if you like them, and it's a new thing we're trialing to put these in there. If you like it, let me know, and I will continue doing it. By the way, 63% of you think the FTSE 100 will be higher by the end of 2025. That's fine. It's not long to go now anyway, so even higher than now. How about the Dow? The Dow, US markets generally, the Dow's probably not a good proxy for the US markets. There's only 30 companies. So, okay, 9 out of 10 G10 countries cut rates in 2025. So you can see there's a lot of money going out there. 18% of the US effective tariff rate. You might say, well, that's bloody awful, but the US consumer has been fine. Black Friday, all the rest of it all seems fine. 27% of S&P 500 capital expenditure comes from 5 AI companies. For the first time in American history, they've permitted monopolies. So when they broke up Standard Oil and made SO, Standard Oil, SO, okay, and they broke up the oil conglomerates about 100 odd years ago under their antitrust or anti-monopoly legislation. They've stopped doing that now. And so the monopolies are winning. They're getting the monopoly of talent and outspending. They can, those 5 or 7 companies, and if you think about it like this, Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA. So the 2 M's, the 3 A's, and NVIDIA, Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA, they can bankrupt the competition. When I was studying economics at university, there was a great example of coach companies. And what one would do was borrow money until they could lower the prices so much the other company went bust, and then they'd raise the prices even more than they had beforehand. Now, that's anti-competitive practices. It's actually a criminal offense. But that's what these companies are doing. And you'll know Amazon does that because they will reduce their prices because they can afford to until all the competitors have gone, and then they gradually raise it. Lidl do the same thing in the UK. They had low prices. Now, if you go to Lidl, Tesco says, oh, no, we're price matching and all that. And they've got Tesco prices. No, not quite Waitrose prices. It's a common practice. These ones are the winners. The problem is, there's an article today from Goldman Sachs. The problem is retail fund managers put too little in these, because retail fund managers, I might as well be impolite of them because I know so many of them are dimwits, whereas the hedge fund managers have greater concentration in these companies, because they're the smarter people. I would say that, wouldn't I? But the retail ones will put 1% in. And if you speak to them even now, all the articles coming out of the retail funds at your pension will be saying, oh, you would be very careful of this American technology thing. It might not last. I mean, we're not even sure that the internet's a real thing yet. And well, the jury's out on computers. Okay, that's your average retail fund manager, whether in the UK or anywhere else. They are something out of the 1940s, not just in dress sense, but in mindset. So what are the catalysts? Well, you can see there the demand for power. I mean, it is an unusual time. Now, I'm not a brokerage. I don't want you to buy and sell more through my brokerage account. I'm not a retail fund manager. I said, buy my fund, it's going to go up, everything. I couldn't care less whether the markets fall or rise. Of course, I want them to rise. I make more money. But if they fall, so be it. I'll buy my stocks, more of my stocks more cheaply and reduce my average entry price. It's fine. Okay, I'm going to put this again in a more in-depth way. I won't go into every single one of these, but you can take a picture of this as well. And again, it's the US large cap quality companies that we're really going to be focused on. Normally, it's not the large caps because they tend to be so big. It's hard for $1 trillion company to become a $2 trillion company. Until now, where you've seen it yourself. It was only yesterday the first $1 trillion company arrived. Now you've got $4 trillion companies. Okay, small caps, AI picks and shovels, possibly. Europe, excluding UK, yeah, and Japan's been doing rather well as well. Well, those I'm not bothered about because I've got enough choice, but you could do an exchange traded fund on that, or Europe if you wished. Small caps tend to be more volatile, so I'm less concerned there, and I'm really mainly in the larger companies, but I could have a smaller cap. I don't like the volatility, and that's the mistake people make. They'll try and sell you small caps because it sounds different, especially if it's a small cap fund manager, because they don't earn fees if people don't buy their product. But the real problem you're going to have with small caps is the volatilities. So yes, emerging markets trade at a discount, but because there's greater risk there compared to US stocks. And we're not going to be doing fixed income. They can do fixed income for us, but bank account is it. Okay. And you're not going to be doing credit, so don't worry about credit. It's for other people. So what are the potential catalysts? Well, some of the smaller caps, according to this, but the capital expenditure, it's just the money which is going around. When Amazon or Apple or Alphabet won't spend money, they're spending trillions now, and that's going through the economy. Okay. Yes, there's a worry that they have such a large impact on the S&P. The S&P 500 is capital weighted, so it is really an index of about 5 companies, 6, Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA. If you don't have large sums of those, you can't outperform the S&P because you're really outperforming them. Okay, so why do so many fund managers underperform? Because they've got all their money in a whole bunch of other companies. I'm not saying have high equity concentration. I'm saying it is a risk. It is a risk and it's a complexity to manage. But I don't mind the fact that of my 20 or 30 odd companies, if you include my son and wife as well, that there is a degree of concentration, any more than I worry that there's a degree of concentration with what Warren Buffett holds and what Bill Gates has as well. Okay, so put in more conventional ways, there's a lot of drivers. I won't go into each of these because it'll bore the pants off you if I did. Virtually the same number of people think the US markets will be up by the end of the year as well, which is no bad thing. Okay. Chris has said, I'm not in any power companies. Is there one or two you could add to the Quality 5? They're in there, Chris. In the Quality 5 Plus model portfolio, there's power companies. They're in the model portfolios. So have a look at the power companies, which are already in there. Okay. I can't add it to the Meta, Microsoft, Apple, Amazon, Alphabet because I can't invent companies that don't exist. Okay. But on a broader portfolio of Quality 5 Plus, there's power companies in there. Not because they're power companies, but because they produce profits and dividends and so on. So they're in there for that reason. I couldn't care less. The mindset of the retail client is, oh, that's a good sector. Let me gamble on that. So what? That's like saying, that's labeling. You need to know, is the company making money? Value, growth, income, cash flow. Bottom up is a far better approach than just picking random sectors. But we've been taught to pick random sectors because if you grew up in the 70s and 80s and read magazines and newspapers before the age of the internet and before any mass data, then of course you had to go by narratives because there was no data. It was stories that our stockbrokers told each other over the fireplace. Okay, over a cognac, over a long lunch. Well, I think, Jeremy, this afternoon we should go in and put everybody in power. What do you think? Okay, well, now we've got data. It's what the modern young man looks at going through town, looks at hardcore data. So he doesn't have to gamble on individual sectors. But old habits die hard. People are obsessed with, oh, no, I've got a bit of technology. I need a bit of pharmaceuticals, I think, to go with my brandy. Why? What the hell sector do you care it's in? Okay. Warren Buffett became the world's richest man by hardly having any tech companies until just a few years ago. As long as they're making money and the price goes up, it doesn't matter. But that mindset is very hard for people to lose because they're not used to looking at data. As humans, we love stories. We don't actually like looking at, who likes looking at Excel spreadsheets other than me and Warren? Public markets, there we go. Increased defense spending, fiscal stimulus, reindustrialization. So Europe, excluding the United Kingdom, does look interesting in many ways going forward. But again, I'm not geographic in my investments. If there are good European companies which bubble up onto our database who tick all the boxes, then fine, we'll have them. I don't care which country they're from. In the sense that I'm not racist. I'm not going to pick them just because they're European any more than I'm sectoralist. Oh, I'm going to pick that because it's energy. Okay, or I'm going to not pick that company because it's Japanese and not American. I don't have an American bias. It just so happens the Americans have 8,000 players. It's like University Challenge. How come Oxford and Cambridge always win? Because they're colleges. So they've got 50 entrants in University Challenge and all the others have got one each. So statistically, who's going to win, let alone they might happen to have the outliers in people who know ancient Roman history. Okay, so economic security, manufacturing, energy, defense, like I said, big numbers. Some of these should bubble, therefore, into the companies. Do you see it's a funnel? All that should bubble into some of these companies, but I'm not gambling on sectors. I look at companies and I say, are they undervalued, i.e. lots of profits, but the share price, you're paying, say, $28 for $1 of profit when you buy a stock. Okay, and I'll show you some of those numbers in a second. Cash return on capital invested. Is it green? i.e. in the top 25% of all companies buy that. Have they got momentum? Because momentum is important. The hedge fund industry will tell you that. Retail clients don't believe it at all. Retail fund managers will never, ever believe in momentum. The richest hedge fund managers in the world are momentum-based hedge funds. Guess who's richer? Jim Simons was the most successful fund manager in history, even more than Warren Buffett. His was a largely momentum-based fund. Okay, so let's look at the S&P 500 and where we are, because we don't want to scare the bejesus out of anybody. So if you just look at simple pattern recognition, what you can see in the bottom half is an averaging out of these prices, short-term average of those above prices and a longer-term average. Then I want you to think in terms of, well, why did you smooth that out? Well, so it's easier on the eye and easier to interpret. We then normalized it. Okay, we didn't invent that indicator, by the way. We then normalized it, so it goes between a range, okay, here, between this range. So again, makes it a bit easier. And then we're just going to use simple pattern recognition and say to you, without any guarantees, because it's limited data, without any guarantees, where are we today on this? And it feels a lot like January 2025. Wait a minute, Alpesh. Are you saying we're about to get a V-shaped fall and recovery? Possibly not, because it's also like January 2022. Oh, are you saying it's going to be a U-shaped fall? Hang on, Alpesh. If you just said we're either going to get U-shaped where it is deep and long, or V-shaped where it is deep and quick recovery, neither of which are nice. And what do we do if that's the case? Or, Alpesh, are you saying, hey, it might just keep going up and up and up? Now, I don't know or care which of those three it is, because the moment I tell you I think one's more likely than the other, you are going to gamble on that or be inclined to. So let's assume we don't know which one of those three it is. So Alpesh is saying, the limits of my knowledge are, I don't know which one of those three it's going to be. I don't care which one of those three it's going to be. Do you see what an incredibly more powerful position it puts me in? Like Warren Buffett, I don't know or care which one of those three it's going to be. So what are you going to do, Alpesh? Well, here's my options. Of course, if it keeps rising, I've got nothing to do. There's only three decisions: buy, hold, or sell. I'll continue holding in all my positions if it keeps rising. Let's say it falls, Alpesh. Then what are you going to do? Well, if it falls like this, where the short-term average falls below the longer term, then I've got two options. Either I'm worried it's going to be a deep, long fall, or it could be V-shaped. So I might sell, and I don't know until it happens. It hasn't happened today, so I'm not going to worry about it. I might sell in the hope of buying back cheaper later if it's U-shaped, but it could become like an insurance premium where I have to buy back more expensive. So two options. Either I'll do nothing, in which case I've got to sit it out for a long period of time and take a lot of pain, not my style, or I will exit with the danger that it's V-shaped and I end up buying back more expensive later. But if it does fall, then I can buy back cheaper, as happened in 2022. I don't know what's going to happen. That's why you're going to watch these weekly updates, because as this then progresses, I'll make a decision then. Guess what retail clients do? They haven't got a clue. So what they do is they prematurely exit. They go, oh, it's going to rain 3 years from now, so I better sell now. Like Michael Burry. Oh shit, something bad might happen one day, so let's just not go out tonight because the sky might fall in our head. That's them. So at the moment, I've got nothing to do. This at the moment still looks okay. Retail clients want to speculate and gamble and overthink, overanalyze, and overpredict. How many times did I just in the last 5 minutes say, I do not know? But what I do know is I've got a good strategy, which is either way, I still win. Am I trying to perfectly pick the bottoms and the tops? No, I let the idiots do that on social media. I let the liars and the forcers pick the tops and bottoms. I've never picked a top and bottom in my life other than purely by luck, like Warren Buffett or Jim Simons or all the biggest hedge fund managers in the world. So if it happened, it was by luck. Okay? Or, sorry, no, tell a lie. There was that one time I got the time machine and the crystal ball mixed up, and I was able to pick the top and bottom as a result. Okay, Stefan, I'll answer your question a bit later on. Anyway, so, of course, buying and selling isn't a binary decision. You might decide, sort of answer your question here, Stefan, you might decide on a scale to 1 to 100, what you will do is either you'll get 100% out or you'll stay 100% in, but you might do 50-50 up until you feel comfortable. And I have a very simple, brilliant flowchart my team have created, which we show clients, which I'm going to show you gorgeous, lovely people now, which is probably one of the most beautiful things I've ever made. Well, there's a couple. There's this one. Oops, let me open that up. Okay, you can take a picture of it. That's about buying. If you're risk loving, you'd go all in. If you're risk averse, you'd go all out, and it's in between. Okay, so you can sort of, there you go. You can do that one, right? The other one I wanted to show you equally importantly is in terms of what should I do, Alpesh? It's this. It's sort of the regret minimization one. And it comes from the research again. When you don't know what the future holds, regret minimization is a pretty good thing. Look at your own lives. What do people at the end of their lives say? They say, I wish I'd had fewer regrets. Okay. Similarly with investing. Regret minimization, when you don't know what the future holds, is better than, oh, I wish I gambled more. Okay. So you can read it in your own time. It's numbered 1, 2, 3, 4, 5. What should I do? Right, take a picture with your phone. I told you to have a phone, so please, or a screenshot or whatever. Okay, so let's talk individual stocks. So at the moment, there's nothing for me to do. Would I buy more? Well, it's a bit overboard. I wouldn't have a problem, but I'd probably want to edge in slowly because I'm a bit more risk loving. I'm more than neutral. I'm a 7 out of 10, let's say. Okay, if I was a 10 out of 10 risk loving, I'd go double up right now because I'm 10 out of 10 risk loving. If I'm risk averse, I wouldn't buy because I'd say it's overbought. And if you're risk neutral, you'd be somewhere in between. Do you see? It's not binary. When you make it binary, what you're implicitly doing is gambling. What you should make it is based on your own risk appetite, right? Earnings calculator. So these earnings are coming out next week, but none of them are going to move the stock market. So they're in a way irrelevant, except for those companies, of course. But otherwise, they're pretty bloody irrelevant. So what's the past week been like? Well, the past week is noise for an investor. It's purely noise. But unfortunately, if you gave this to a bunch of retail clients and said to them, hey, what do you think from this? They'd start making all sorts of convoluted theories on investing all of a sudden. It's nuts. This is noise. There's nothing for you to do. And I'm not the only one who's ever said that. Warren Buffett said it. Well, what about Broadcom, Alpesh? What the hell? Surely we should be buying Broadcom and getting out of Oracle. No, not necessarily. We need to look at value, growth, income, cash flow, Sortino, and all of those factors. In the short term, the stock market looks like Brownian motion. It's random. You know, at school, you used to put pollen on water and the atoms would hit the pollen and move around and around. In the short term, on a weekly basis, it is the mathematicians will tell you it looks like random movements. It's only over a longer period of time, and that's why we're investing. Now, we can trade, but this is not a trading webinar. I have no problems with trading, but it's a completely different mindset than webinar. Okay, and again, from Meta and Google, which, by the way, for those of you thinking, well, it's a tech company, no, apparently they're communication services. So much for sector. Oh, Amazon's a consumer cyclical company. Did you know that? You think it's a tech company. Oh, right. I didn't know that, which I thought they were all the same. No. Tesla's a tech company. Yeah, it's called auto manufacturer. Bloody hell, it's a tech company. Okay. Now, past year, that's a bit more interesting to me. And this has got a lot of surprises. At Christmas, I'm going to take this and I'm going to remove the percentages. And, you know, Christmas in my place is really exciting. You're all welcome. And get people to fill it in and as a guess and see who gets closest. So we're going to put it up and everyone's going to get one of these sheets with their numbers. I can say, okay, everyone, what's your guess of how much Apple went up? In my household knows nothing about investing. So somebody might go, oh, Apple, 30%. And the person gets closest to it, they get an apple. Okay, so it's a little game I've created, a board game that I've created. It's going to be huge. Now, over the past year, guess what? My NVIDIA holding, and this is going to surprise some of you, and it's why you have a portfolio of stocks and not just one. My NVIDIA holding is up less than my Goldman Sachs holding. And if you told me that 12 months ago, I would have said, you are absolutely flipping insane. There's no way that's going to happen. NVIDIA's going to go up tenfold this year. I would have said 12 months ago. It's only up a quarter. And my Goldman Sachs is up 35. Since when does Goldman Sachs, an investment bank, go up 35% in a year? Guess who gets more column inches? NVIDIA. Guess who people talk about more? That's why you don't just have one stock, obviously. I mean, I know that's stating the obvious. And there'll be cycles and stuff. What private investors try to do and get completely wrong, and this is why they're gambling, is they try to get every single stock to be a winner, every single stock to be a big winner, and they're disappointed when it doesn't happen. And then if for a few minutes it drops, they panic. And if for a few hours it goes sideways, they get bored. Panic and boredom are the two reasons why I could give them Microsoft at the start of 2021, and I guarantee you, every single one of you would not hold it to the end of the year and make a 50% return. Because that's what happened in 2021. It went up 50%. Because 9 of those 12 months, it fell or was zero. So I'd lose half of you on the panic when it fell, half of you on the boredom. Because for 9 months, it delivered nothing. And I'd be the only one having done nothing but sat on my backside the whole year and made 50%. Because it ticked all our boxes: value, growth, income, cash flow, Sortino. Your enemies are everybody that makes you panic and get bored. Who's that? Every single news channel, every single TikTok video, every single YouTube video, every single journalist trying to sell you a newsletter, every single broker trying to say, there's this new shiny thing, there's this new shiny thing. The only one telling you to do nothing and just smell the roses and play with your family and kids is me and Warren. As long as you've got quality companies. But private investors can't help themselves. Private investors, next time I come back, I want to come back as a stockbroker firm. I want to be reincarnated as a stock brokerage firm and Ladbrokes, because private investors love two things. They love destroying their wealth by overtrading, and they love gambling on the high street at Ladbrokes. Okay? That's why the lottery does so well. Now, so I should put the microphone up a bit higher. There we go. Now, that's the past year. Let's get into a bit more honest truth. Now, exchange traded funds, I'll do a separate dedicated video. Exchange traded funds, just think of them. I'm a big fan, as you know. Just think of them as index trackers. Okay. I haven't looked at the India one, which is the India one. I'm going to look at it now, actually, for you guys. Not because I'm company specific. My father has a company floated on the Indian Stock Exchange, so I've got enough exposure, and I've got an angel investment in India as well, so I don't need to be investing in this. But the advantage that exchange-traded funds have and the disadvantage I'm going to tell you. First of all, the advantage, they are diversified because they have a pocket of stocks. The other advantage is this rule here. I'll just get rid of the weekly so you can see it. This general MACD rule applies to most exchange traded funds most of the time. Okay, it's no guarantee, which is if this is rising, can you see the green line? If it's rising, then the price is likely to be rising. If it's falling, then you don't want to be holding it. Okay, it's as simple as that. I'm going to keep it simpler than it needs to. It's a bit more subtle than that, but I like that. So at the moment, it's just flattening out. We don't know what's going to happen. We go sideways for a bit. That's one advantage. You can just use this without thinking, oh, well, what's happening to India? I better take a flight out. You ain't got the time or energy for that. Oh, I better look at the macroeconomic analysis and the data of the balance of trade payments and unemployment data. No, you ain't going to be doing any of that. You can just use where are people putting their bloody money who are reading those reports. Okay, because that's the way to cheat. It's a backdoor key. Where are people putting their money? People talk a lot, but actually where they put their money is what matters. If somebody talks a lot, has got no bloody money, what the hell do I care what he thinks is going to happen with the market? What I care about is who's actually buying this stuff and who isn't, and that is revealed through prices. So that's an advantage. You can use this. A disadvantage is, by the very nature of exchange traded funds, it is rare that they generate those kind of returns, doubling your money in just that kind of period. What they generally tend to do, and this again, it's pretty rare, 50% up in that short space of time. What they generally tend to do is close to that kind of angle. Okay. A would be lovely. B would even be lovely. C is more likely. How do we know it's more likely? Well, it's more the longer term average, and and if you divide it across, then you can see, if you move it there, that's what it roughly tends to be, because you're talking countries. Countries tend not to, unless they've had steep falls, have 100% returns. And actually, once they've had a steep fall and this starts flattening and rising, is the best time to buy, when it's in this bottom half. So if you get this pattern again, that's the ideal time. So in fact, with India, you want it to fall a bit more before getting in, because it gives you a greater likelihood of making money. Okay, that's if you are obsessed with India and want to buy it. The same goes with any of these. The same analysis I've just given you goes with any of those. Okay, so with something like India, I'd rather wait until it falls a bit more. If it doesn't fall, so be it. I've got somewhere else I'll have to give my money. I've missed the train. Doesn't matter if I missed the train. There'll be different trains coming along. Okay, so where are we over the past year? Very, very unusually, and this is going to fool a lot of people. The UK is up more than American markets. Now, I can tell you, every single time that's happened since the Second World War, it's not repeated the subsequent year. But guess what private investors are going to do? Because we know from the academic research, private investors do this. They invest always in last year's winners. So a flood of money is going to go into UK stocks, despite the fact that all the evidence to the contrary, macroeconomic, statistical, historical, that would not be good for the subsequent year. But it will go in because the advertising is about to start. Hargreaves Lansdowne got a shout out in the budget because they managed to pull the wool over the chancellor's eyes and tell her, hey, if you reduce the cash ISA, take the money away from those banks offering it and give it to our stockbrokers and promise they'll invest in UK stocks. Well, no, they won't. No, they won't. They'll either spend the money, or if they become owners of shares in a UK company, that money doesn't go to the UK company. Only an idiot would think that, any more than if I buy a Gucci scarf from the homeless guy, that money goes to Gucci. It doesn't. Gucci got their money. It goes to the homeless guy who was gifted it by somebody who walked past. So the only way British companies get that money is if you're an angel investor pre-IPO. Sorry, you can't do that in an ISA anyway. Hargreaves Lansdown were very good at lobbying and saying, no, send it to us. We'll put it in. So where's that money going to go? The little that will go anywhere. It'll go to the fund managers at St. James's Place that they're distributing for, or Neil Woodford that they're distributing for. It's a closed place, the city, and the clever ones will always fool the socialists. Socialists don't like capital, so they've never bothered to understand it. Okay, so that unusual for it to be falling behind, but it's been a good year. Broadcom, 1 year, 145% up. Alphabet, 90. Tesla, I don't have Tesla, not because I don't think it'll do well over the next 5 years, but because I don't like the volatility. Okay, I don't like the right? Microsoft, that I think is relatively cheap. Basically, you're paying $34 for every dollar of profit Microsoft makes. That is cheap relative to its own history, relative to other tech companies. Okay, that's cheap in that regard. But cheap and valuation are not the only things that move stock prices. I mean, British ones tend to be even cheaper, but then people find it hard to believe that they're going to do incredibly well. Look at that. Been phenomenal. The banking side, yeah, absolutely. Well done. And long may it continue, and hopefully it will next year, but it'll be the few, not the many. And you really are gambling on the few. I'd rather have a database where I can choose and filter through. And when we do this database, if we do get ones which are British, which are in the top 200, well, great. You know, none of these are, by the way, but I'm just saying, you can see as we go down here, there's a hell of a lot of blue ones which don't make the cut, I'm afraid. And that's every single UK listed company and every single European companies on there, which you can have in your SIP or ISA, I'm afraid. And there's a lot of American ones which don't make the cut either, as you can see. None of these make the cut. But Britain just has fewer companies. That's the problem. Great country, too few companies, unfortunately. Now, this is what could happen with the S&P. I want you to pay great attention to this. It's really important. What could happen with the S&P? You see that with the average prices. Normally, they cap and fall. Look at that. Cap and fall. Okay? Cap and fall, or glass ceiling and fall. Okay? Cap and fall and fall. Right? This time, something unusual has happened equally here. Right, so cap and fall. What's happened here is there's been a breakout, it's gone up, and that might continue. Now, that's because, of course, in Britain, we've got zero unemployment. We're growing at 10% per annum, and the latest AI companies that we have, which is floated on the stock market, are driving it higher. Of course, none of those things are true. It's not fundamentally driven by economics or corporate profits. Probably just catching up. Let's not forget. And there's a currency issue related to it as well. Let's not, because most of their profits are in dollars. So once you convert it back into sterling, it looks better if sterling has fallen. It was only a few months ago, it was at 2019 prices. This year, 2025, the FTSE 100 was at 2019 prices. Maybe it's just caught up a little bit temporarily. Whatever it is very unusual for it ever to beat the American markets. And if it doesn't do it for a second year. I don't think it's ever done it for 2 years running. Who knows? It might be the first time ever. Feel free to risk your whole pension on that, though. S&P 500 leverage, 2 times leverage, which I also happen to own. I'm okay with. It's still going higher. Let's see. The only point I'd consider selling is if this starts dipping again here. might sell a little bit, might not. And if it falls below, like there. Okay. And the earliest I'd ever think of buying would be if this has just started going from flat to rising and this is rising. That'd be the earliest I'd ever think of buying. So I don't try and get in early or try and pick bottoms. I get in a bit late. So be it. Okay. Bitcoin, because I was asked about this by a client of ours. That's the uptrend. It seems to have broken down from it. Technically looks like a daddy bear for the first time in a long time, but it could just be a V-shaped recovery. So either it's going to do this, which at the moment, this looks like that, or it's going to have a quick V-shape. I'd probably put my money on a more declined fall, only off looking at average prices, not looking at any kind of macroeconomic analysis or anything like that. Steve, I'll answer your question shortly as well, Chaz and everybody else. So Alphabet. Now, did I think Alphabet was going to do this? No. Why do I own it then if you didn't think it was going to go through the roof? Well, I thought in a mixture of my portfolio, it'd be one of the stocks which should do well, and I've been right, and indeed it has. Okay, I don't try and say all my stocks will go up. Warren Buffett's never had every single stock in his portfolio go up in any year since he started investing. So since 1945 or whenever he started, 1950, whenever he started, till now. There has never been a year where every single one of his stocks gone up, and he's never had the best performing top 10 stocks of the stock market in his portfolio in any given year. Yet he became the world's richest man. Just good companies for a little bit of time. What's the good companies? How do we decide what the hell's a good company? But there's the rub, Alpesh. Yeah, those are the factors. Well, how do you know these are the factors, Alpesh? Value, growth, income, cash flow. Well, that's Goldman Sachs. That's the hedge fund industry. And value, growth, income is Richard Thaler, Daniel Kahneman, Eugene Fama, amongst every other piece of literature out there. And if you want to learn more about it, I've got a free, completely free online program which teaches you all of that literature as well. It's completely free. It's at investing-champions.com. So and I don't mean free for 7 days, it's free forever, so you can learn about it. One of the other reasons why I like Alphabet, other than the fact that when I bought it, it was on the list. By the way, if it for any reason were to drop out of the list for a month, it doesn't matter, because the entry rules are not the same as the exit. The entry rules are value, growth, income, cash flow, Sortino. The exit rule is if it's a model portfolio, then it'll be a 3-year hold. Otherwise, at least 12 months. And a daddy bear if it's what I call one of the quality 5 plus. Which are the sort of 40-odd stocks that we have, which fit this rule, that we can apply this simple rule to, as well as value, growth, income, cash flow. So in any event, nothing to overthink. I'm holding it at the moment, and I have no reason to sell it. So buy, hold, or sell? Well, hold. No reason to sell. Would I buy more? Well, cautiously, because it is overbought. And statistically, when it goes like this, it can often fall back. Buffett bought into this here. Bought into it well before him. Does that make me a better investor? No. But it was bloody nice when he bought it. It was like a Christmas come early, because it means, Alpesh, your long lost father figure, Warren Buffett, was right. Came in and joined your party. Will I sell if it does this pattern again? Well, we'll decide when that happens, because it might be a V-shaped recovery. What we're really looking for on that is the kind of companies which, when you look at their return distribution, they snap back. So with Alphabet, if it drops 25%, you should fill your boots with it, not exit in a panic. Why? Because it tends to move this way. Why do people then panic in a company like this and sell at 11%? Well, you wouldn't sell at 1%, would you? Or 2% drop, or 3%. Would you sell at an 11 in the expectation it might drop to 28 and then to buy back more? So you're looking to buy back cheaper later? Yes, but the risk is you miss the train. That's the timing problem, which is why most people are told don't bloody try and time it. Either sit through it or buy more when it falls without becoming overly concentrated. But the risk of trying to time is you get out when it drops, say, 11% in the hope it'll drop 25 and you'll buy back cheaper, but it never does it. Now, that's common sense, what I've just said to you, that you could miss it. So that's the danger. And if you're the type of person who could miss it, which is probably 90% of my clients, then I say to them, just sit back. Stop trying to be something you're not. You can't go and be, it's like if I give you a Ferrari, you're not going to be a Formula One driver just because you want to be. So just sit back, mate. Stick to the Prius. which is the buy and hold way of doing things. But I want the kind of stocks which have certain characteristics. They don't drop too much. And if they do, they have a statistical increased probability of rising. Why do they have a statistical increased probability of rising? Because underlying their stock price is the fact that on a value, growth, income, cash flow basis, and we score this out of 10, they're a green. They have to be a 7, 8, 9, or 10 to be a green. On their cash return on capital invested from Goldman Sachs, that one, they're in the top 25%. They generate lots of cash. Companies have 3 sets of accounts: P&L, cash flow, balance sheet. They've got lots of assets. They've got lots of cash being generated by their business, and they've got lots of profits, and they're growing. And their stock price doesn't reflect. I mean, you're only paying, say, $28 for $1 of profits. It's like buying a house, and you buy the house for $28 and it's got rent of $1. You might say, well, why would I do that? And I say, well, because all the other houses are $50. So you go, oh shit, I'll buy that for $28 and sell it for $45. That's the price of houses. Okay, so it's a bit like that. Microsoft, slightly, if anything, bit of a slight concern, not major. In that it's now falling. So prices can do one of two things, as you know. They can go up or they can go down. What we're more interested in is when they go down, because that's when panic could set in. So to avoid panic, we do 3 things, and we use the Goldilocks analogy. Okay, we say if it's falling, the price is falling, we'll call it a bear market. If the the average short and medium term prices are rising, we'll call that a baby bear, and you can ignore it. If they're also falling, like is the case here, we'll call that a mama bear. And if they fall below their moving average, we'll call it a daddy bear. This only applies to the quality 5 plus 40 odd stocks that are in what's called our quality 5 plus portfolio, which my son and wife are invested in. It doesn't apply to the 10,000 others. And they've all got to meet the value, growth, income, cash flow sortino when we first bought them. They might not every month, but on entry, they have to. Okay, because they're then capable of it. They're that good a company. And if they don't for a month, they'll revert to mean and go on to do it in the future. So that's then called the daddy bear. Now, at that point, again, as I've said many times, I've got a choice. Either I sit through it, in which case I might hold and get 0 return for a long period of time, but I have a quiet life. Or I exit in the hope I can buy back cheaper later, but I might end up buying back more expensive. And I've a lot of people who try that and they get it wrong. So they're better off just sitting back. Okay. And Microsoft, again, statistically good. Guess how many companies have a profile like this? Low and shallow falls, likelihood of good average returns. It's about 10 on the entire stock market. Okay. NVIDIA, value, growth, income 7. I continue holding it. I can't tell whether it's a mama bear or still a baby bear, but we'll ignore it. The danger is it does this. So what? The bigger danger is it does this. Well, thankfully, this daddy bear only happens once every 7 years. This type of V-shaped also only happens really once every about 4 or 5 years anyway. But anyway, we continue holding this. And there's its return histogram. Now, deeper falls, a bit more worrying, but the rewards are greater. So if this fell 40%, I'd want to buy more. But the danger is, so what's your exit point? Do you get out if it drops 20? No. What about 30%? Yeah, but then it's so close to 40. What's the point? It might snap back. So there's going to be an answer between probably 18 and 28 where it makes more sense to get out. But the danger is you get out at 20% fall and you never get to go back in. So you might want to do it gradually if you really want to be a trader. Otherwise, just sit back and take it. For my system, we put 9,000 stocks in there. We look at value, growth, income, momentum. Okay, try and get that statistical edge of Sortino. When I won the competition in the Financial Times and ranked first and forecasted what the FTSE would be over a 1-year period and beat all the